Crude oil prices are expected to remain subdued in 2026 in a year of uncertainties. Key factors influencing the outlook include geopolitical developments such as the situation in Venezuela, ongoing negotiations between Russia and Ukraine towards peace, as well as subdued global economic conditions. Ukraine said last year that it was now ready to withdraw heavy forces from parts of the Donbas region it controls if Russia will respond with a similar pullback as part of a peace deal. Over the weekend, President Donald Trump announced that American forces had apprehended Nicolas Maduro, Venezuela's leader, along with his wife, and transported them out of the country. During a press conference, Trump stated that the United States would administer Venezuela on an interim basis while Maduro stands on trial for various charges in the US until the country transitioned to a stable democracy. Oil prices are anticipated to adjust following these developments, given current abundant supplies. Nevertheless, projections of a seamless transition under US oversight and substantially increased oil production should be regarded as optimistic at this stage. However, China remains capable of delivering unexpected growth due to its efforts to stimulate faster expansion and increased energy demand. In addition, by 2026, the impact of artificial intelligence on energy consumption is anticipated to be significant. Its full effect remains uncertain, but may substantially alter demand projections depending on advancements in AI technology adoption. On AI, there are three fronts to watch in 2026. The intersection of context and privacy is likely to result in live AI systems that offer more user-friendly, robust, and granular controls. As AI solutions begin leveraging organizational proprietary data, the focus is expected to shift from generating high revenue to delivering tangible value by transforming efficiency. Additionally, the emergence of cost-effective Chinese and open-source models, growing market skepticism, and an influx of European AI solutions, they are all anticipated to significantly alter the competitive landscape and potentially prompt a market correction sometime in 2026. Hello and Happy New Year. After a brief holiday break, we are back to offer you carefully selected business insights and perspectives designed to help you interpret trends and navigate what many expect to be an unusual year. Our first episode dives into the global crude oil market. Earlier in December, the US Department of Energy reported that crude oil inventories in the strategic petroleum reserves were up 800,000 barrels to 413 million barrels in the week as administration replenished depleted stockpiles. A significant discussion in the United States centers on determining the threshold at which declining crude oil prices will lead investors to reconsider their positions due to unfavorable economic conditions. Shale drillers are deploying new technologies to reduce cost per barrel as experts warned that US oil production could see a negative hit if international oil prices linger under $60 per barrel, driving retrenching, less investments, and idling rigs. Super majors in 2026 continue to lower drilling costs in the shale patch by researching cheaper proppants and surfactants to maximize recovery rates from existing wells in basins already established to be rich in oil. This comes as measures to ease the business environment for producers by the US government begin to pay off in enhancing attractiveness. Last year, the US House of Representatives passed a bill to accelerate environmental assessments and government permits for energy projects and data centers. It is also considered the first significant update to the NEPA Act, which dates back to the Nixon era in 1969. On the Maduro shock effect, analysts expect that Brent crude prices could rise only marginally before stabilizing downwards, depending on the trajectory of the transition process. Regarding demand, analysts note that the United States also plays a significant role. They suggest that the delayed effects of tariffs postponed negative consequences, which are expected to appear in the first quarter. This comes after US GDP growth in the third quarter surprisingly reached 4.3%. Growth in emerging markets, especially India, will continue to drive demand. But the major emerging economies are also pursuing alternative energy sources. They're doing this more aggressively. For example, China is speeding up solar thermal power development in a new policy roadmap unveiled with plans for 15 gigawatts of new capacity by 2030. Also, in late December, India's parliament passed the so-called Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India legislation to open the India nuclear energy sector to private investment, ending decades of state monopoly and repealing the Atomic Energy Act of 1962 and other acts that hindered expansion of India's civil nuclear industry. India expects the new legislation to spur private investment in nuclear energy. Basins like Nigeria are putting up more blocks for bidding, but also at a time when Mexico's state oil firm Pemex saw weak bidding and less foreign participation than expected, as it offered 11 joint venture blocks to bolster production at mature oil fields. With a lower oil price outlook, bidders are much more sensitive to terms and the economics as the new technologies continue to help to produce at a reduced cost from existing wells. Oil majors are in a broader strategic reset focused on capital discipline and more efficient and seamless execution. BP, for example, is selling a 65% shareholding in lubricants business, Castrol, looking to divest $20 billion of assets by the end of 2027. BP is returning to its core business, and that is concentrating on profitable oil and gas exploration and development while avoiding regions known for complications. Nigeria is making available 50 oil and gas blocks with the objective of attracting $10 billion in new investments over the next decade and increasing production by an additional 400,000 barrels per day. The offering comprises 15 offshore deposits, 19 frontier fields, and 1 deep water block. This announcement was made by the Upstream Petroleum Regulatory Commission, which has recently undergone a change in leadership amid concerns regarding corruption and, of course, security issues that continue to drive up costs and risks. The 2026 Nigerian budget projects crude at $64 a barrel, somewhat optimistic in a year which could see a range bound $55 to $60 per barrel for Brent. An aggressive price projection by the Nigerian government highlights the ongoing fiscal pressures, even with expected tax revenue gains from the new Tax Act. In short, in 2026, with ample supply and demand under an array of pressures, $60 per barrel Brent is no longer a flaw in a market less sensitive to geopolitical risk. A turbulent 2025 from a geopolitical perspective has already led to factoring in much more risk premium. For instance, sanctions against Russia and various geoeconomic risks related to supply have already been factored into current market prices. Of late, we have seen recent reports of attacks on oil infrastructure and tankers, resulting in only very modest price fluctuations. Indeed, if you discount for a generous risk premium already factored, Brent crude may be actually closer to $55 per barrel than we think. Looking ahead to 2026, beyond oil, analysts also warn that the global trading system faces instability with falling U.S. import volumes and rising imports in Africa, the Middle East, Latin America, and India. A key unknown is a pending U.S. Supreme Court decision on Trump's reciprocal tariffs, which could lead to refunds to U.S. importers and changes in tariffs already applied, as well as, of course, a lot of disruption in that space. Demand for energy is correlated with economic growth in major economies, especially China. China's leader Xi Jinping said it met its 2025 growth target of about 5%, with growth in exports helping amid slowing investment and a lingering property crisis. Still, the latest official manufacturing purchasing managers index showed that factory activity unexpectedly rose in December, ending 8 consecutive months of contraction. 2025 saw a lot of volatility. The S&P 500 was up 16%, still short of 2023 and 2024. The tech-heavy Nasdaq slightly better, up 20% gain. Nvidia, that's the AI bellwether, was up 39% year on year. Alphabet shares jumped 65% in 2025, their sharpest rally since when the stock doubled coming out of the financial crisis. Dow was up 13% in 2025. Gold rode the uncertainty well, up 64%, while Bitcoin fell 7%. U.S. manufacturing PMI data just out showed continued job growth through late 2025, with December's index at 51.8, down from November's 52.2. Eurozone manufacturing declined at year-end, with production falling for the first time since last February. The manufacturing PMI slipped from 49.6 in November to 48.8 in December, marking its lowest point since March 2025, though the contraction remained mild. The UK manufacturing sector showed growth before year-end, with output rising for a third month and new orders improving slightly for the first time since September 2024. The S&P Global UK manufacturing PMI increased to 50.6 in December 2025, its highest in 15 months. Nigeria's Stanbic IBTC Bank PMI for December edged down to 53.5 from 53.6 in November, but still signaled solid growth. And back to the theme on oil, prices inched slightly up in the first trading session of 2026 as geopolitical tensions continue to provide support. The gains follow a volatile 2025 in which both Brent and the West Texas benchmarks fell by nearly 20%, their worst annual performance since the pandemic-driven collapse in 2020. Pressure will also come from tightening U.S. measures against Venezuela's oil sector, as Washington effectively blocked sanctioned vessels from entering or leaving Venezuelan ports, further constraining exports. How quickly can oil and gas infrastructure and supplies be restored? More questions than answers as far as Venezuela is concerned. French President Macron says the upcoming transition must be peaceful, democratic, and respectful of the will of the Venezuelan people. Will crude oil prices crash in 2026? Demand will track the economy, which is no doubt still looking tepid. That's the global economy. Supply is still ample, though the geopolitics continues to take its toll on prices. A crash, perhaps unlikely, though the floor is likely to be much lower than in 2025. Well, that's it on our first special edition of Global Business Insights in 2026. This is Bode Oshosani again. Happy New Year. Bye-bye.